In this video, we'll look at money market funds to see how they can help you as an investor. I'm Romin, a financial YouTuber from PensionCraft, and today I'm collaborating with Trading212 to teach you more about investing. Remember that nothing in this video should be construed as financial advice. What does a money market fund offer you as an investor? Primarily, money market funds are used to hold cash over a short period of time. Money market funds can be held in an investment account, such as an ISA, and they generate a small rate of return that's comparable to the rate of interest on a bank account. Unlike some bank deposits where your money's locked in for some period of time, money market funds can be sold at any time. Generally, investment is a trade-off between risk and return. The greater the risk you take, the greater the potential return on your investment. Money market funds sit at the low risk, low return part of this continuum. They're usually safer than bonds, stocks, and alternative investments. The reason why money market funds are safe is that they contain safe investments. The first way that they ensure safety is that they only buy investments issued by companies with very high credit quality. These borrowers are extremely unlikely not to be able to repay their loans. For example, this iShares money market fund has about 2/3 of its investments in AAA rated debt. That's the highest credit quality. The other way that money market funds keep their risk low is to only have loans and debt that mature quickly. By locking in rates over a very short period of time, these investments have returns which are very cash-like, and that means that they fluctuate very little. For example, that iShares fund that we saw previously has 58% of its investment in debt that matures in 1 year or less, and all of its debt matures in less than 3 years. The fact that money market funds focus on debt which is short-term and high credit quality means that they can only buy a restricted set of investments. This would include UK short-term government bonds, but also IOUs issued by high credit quality borrowers. This is also called commercial paper. They also make short-term deposits at banks called certificates of deposit. You may see references to QMMFs or qualified money market funds. So what are these? There are strict rules from regulators that govern whether a fund can be designated a qualified money market fund. Primarily, these ensure that the fund is cash-like in that it maintains its value and doesn't crash in value. In financial parlance, it maintains a net asset value which is constant, or constant plus accrued earnings if it's an accumulation fund. Furthermore, it's restricted to investments that mature in no more than 397 days, with an average maturity of 60 days or less. And it should be very liquid. In other words, it can be sold very quickly in return for cash. The price you pay for safety is low return. So what kind of rates of return can we expect for money market funds? Many UK money market funds have a return which is benchmarked or aims to match an index known as SONIA, the Sterling Overnight Index Average. This is the rate at which banks lend to each other. You're probably more familiar with the Bank of England policy rate called bank rate. SONIA, seen here in yellow, matches bank rate, shown in blue, quite closely. So as the central bank raises and cuts its policy rate, so the income on money market funds increases and decreases. We can see that directly if we look at a money market fund with a ticker CSH2. Notice how the price, seen here on Trading212, steadily increases. That's because this is an accumulation fund where the income from the money market fund is reinvested. If we compare the price of CSH2, shown here in blue, with the compounded rate of interest of SONIA, shown in yellow, you can see that it's tracked it quite closely. The flat period from 2020 to 2022 was when bank rate was set to 0 in order to stimulate the UK economy in response to the effect of the COVID pandemic. Then as inflation spiked in 2022, the central bank, the Bank of England, raised interest rates in order to curb inflation, and consequently the rate of return on CSH2 increased. One of the greatest risks of money market funds is that you hold your money in them for a long period of time. If we compare the return on CSH2 with a global equity fund, you can see that the low return on the money market fund means that you would have underperformed. This is why money market funds are only used to store cash over the short term. Depending on the type of money market fund you buy, the price may fluctuate slightly and may fall, unlike a savings account, and of course unlike cash. For example, if you hold an income version of a money market fund, such as iShares ERNS or EARNS, it has this ramp shape where the price of the fund falls periodically as it pays out its income. Other funds, like JGSA, have a slightly longer maturity, which means that their price will fall as interest rates rise. So make sure you take a look at the price of the fund that you're going to buy in order to understand how it behaves. That way you can avoid any surprises after you've bought the fund. I hope that's helped you understand how money markets work and how they could fit into your investments. Please do like this video if you found it helpful, and remember to subscribe to Trading 212's channel so that you don't miss any future videos.